Here's some interesting things about Walmart symbol, WMT. Okay, this was an old symmetrical triangle formation. It eventually broke above it, but I want to zoom into this area right here. Here I have the volume, and here I have the 14-day relative strength index, and at the bottom I have the average implied volatility of options. First, I want you to take a look at the bottom chart, the implied volatility one, and notice that right now, even though you might be saying, well, the market is definitely volatile, implied volatility is very, very low right now. So what does that mean? That means that as traders we should be looking at perhaps buying options. Okay, so we have that. Now I want to go into the 6-month chart, and here's the 6-month, and I already made the point with the implied volatility, so I'll get rid of that, clear up some space. And here we have the most recent price action. You can look at this and say, is this some sort of symmetrical triangle, ascending triangle, maybe a really gross head and shoulders? Well, let's take a look. Okay, head and shoulders, there'd be high volume on the first, then low on the other two. Okay, so it's not a head and shoulders. So we'll say it's some kind of triangle. Okay, so what I wanted to look at, I wanted to do a little divergence analysis with the RSI. Notice this. Okay, we have a first high right there. I circled it. And corresponding to that level, we have a high in the RSI, relative strength index, right there. Next, we have a higher high, and we have basically the same level as the first high in the RSI. So no warning signals there. And then we have another push to this level at about 50, 58, 84, 59 bucks. And then suddenly we see, so we have upward here, a high there, but for some odd reason the RSI has declined all this way. That's a negative divergence. It should alert us that there is going to be a top in place. Okay, so what's so significant about this 59 level? Well, go back to the 5-year chart. $59.62 was the ultimate high in Walmart. Circle it right there. Make it a better color. That was the ultimate high in Walmart, like, I think forever. Yeah, the highest high ever in Walmart history. And that was right before the 2008 bubble popped and the Great Recession started. So it's a very significant level. I definitely expect it to act as some resistance. So jump back to the 6-month chart. We'll do our normal measurements that we always do. I'll get rid of the RSI. We know there's a divergence. We know that's negative. And here we just have a simple chart. Okay. First, I drew some old trend lines. As you see, this one might act as a support level. It might, just might. And our price target will be, let's start here, will be conservative and go from the middle of the pattern. Price target, if it broke out to the downside, would be about $55, $54.50. And if it broke out to the upside, it would be, let's see, 57, 54. It would be $62. So, what would you do in this case? Well, I already gave you this. You know that options are cheap. We should buy a put. Or actually, you know what you could do? Let's do a ratio spread. We're not expecting this to go up, and if it does, we're not expecting it to go up that much, because even from my normal Elliott wave analysis, right here, we don't expect the market to go up a ton. We expect it to get maximum to the level it was in May. So we'll do ratio spread here. So what would we do? WMT, we'll go a few months out, so I'm going to go with June 2012. We think it's going to go down, And if it goes up, we don't think it's going to go up that much. So depending on your own risk tolerance, you can buy the 57.5 call and sell 2 of the June 60 calls. Or you could buy 1 of the June 60 calls and sell 2 of the 62.5 calls. So, okay, this is what the entire strategy would look like. Okay, so I'll do the first one first. Buy the 57 and sell 2 of the 57.5. So get those again in my chart. Okay, so sell 2 of those. So this is what our risk tolerance looks like. And our risk management strategy, we always want to get out of a ratio spread once the stock price hits our our short strike price. So in this one, we would get out if it breaks above $60. So with this one, we would have, let's see, 48-cent credit just about, and our maximum gain about $300. Maximum loss, of course, is infinite, but if we stick to our risk management strategy that I already put out, then our maximum loss is closer to $60. So that's the first strategy. That's if you are aggressively negative on this stock. Second one would be buy the June 60 call and sell 2 of the 62.5 calls. This only gives you a $5 credit, but your break-even point is going to be 62.50. Well, that's your stop point, and your loss there would be maximum $104. So the idea is this one you have a better chance of making money, but you're putting more at risk. So your maximum loss is going to be $104, while the other one that I mentioned, your maximum loss would be closer to 60, but you do have a lower chance of making money. So there's their strategy. Another one you could do is you could just outright buy a put, stick with the June 2011, and we'll sell the stock once it hits our price target. So the June 57.5, and we expect it to go to about 54.50. I mean, buy, my bad. So if it gets to about 54.50, that gives us around $200 gain. If you're really aggressive, go ahead, try the 60. If you bet the 60 and it goes down there, you're making $200 again. Actually, between the two, never mind. Yeah, the 60 you'll make a little bit more money. You'll make closer to $250. So there's a strategy for you. See how it works out. Happy trading.